All right, let's jump right into this explainer. Today, we are investigating a seriously fascinating financial mystery. We're looking at the incredible, almost unbelievable market run of a company called FormFactor, which trades under the ticker symbol FORM. Now, if you've been watching the tech and semiconductor space lately, you know that valuations can sometimes get, well, a little stretched. But what we're going to unpack today is a textbook case study in what happens when a stock's price seems to just completely detach from its underlying financial reality. We're going to dive into the hard data, strip away all that market noise, and figure out exactly what is going on behind the curtain of this massive rally.
Just look at the sheer scale of this momentum. We aren't just talking about a pretty good quarter or a solid year here. FormFactor stock has absolutely skyrocketed, climbing over 450% from its 52-week low of $26 to approach the mid-140s. That kind of explosive upward trajectory is honestly incredibly rare. When you see a huge number like 451% in a single 52-week window, it usually signals one of two things, right? Either the underlying business has fundamentally transformed and unlocked massive new profit streams, or the market has just been swept up in a giant tidal wave of speculative hype.
To figure out how we actually got here, let's trace the yearly returns, because the historical context is wild. After a really rough year back in 2022 where the stock dropped over 51%, FormFactor caught a massive tailwind. They bounced back 87% in 2023. But the real kicker is right at the top of that data. Factoring in projections and recent market pricing up through 2026, we're seeing a massive 158% return loaded right into the front end of this current cycle. And this perfectly sets the scene for our mystery. The market is aggressively bidding this stock up, clearly pricing in a ridiculously optimistic future. But we have to ask, is that optimism actually grounded in reality?
So that brings us to Section 1, the 400% explosion. Justified or pure hype? Let's look under the hood.
Section 2, a bulletproof balance sheet. The good news, because before we get critical, we've got to acknowledge what management is doing right. And what they're doing right is managing their risk. Check out their debt-to-equity ratio. It's sitting at an astonishingly low 0.01. In the corporate finance world, this essentially means debt is practically non-existent. For every single dollar of equity the company holds, they have just 1 penny in debt. They aren't bogged down by heavy interest payments, and they definitely aren't at the mercy of rising interest rates squeezing their profit margins. Which brilliantly illustrates a major core strength for them. FormFactor essentially owns its financial house free and clear. No relying on borrowed money. In an economic environment where so many tech companies are leveraged to the hilt to fuel their growth, FormFactor has built this incredibly strong, fortress-like foundation. If the economy takes a downturn, or if the whole semiconductor equipment cycle goes bust, they don't have bankers knocking on their door demanding loan repayments. They have total financial autonomy. And their liquidity totally backs this up. A current ratio of 4.50 means they have $4.50 in easily accessible assets for every single dollar of short-term liabilities they owe over the next year. Even if you look at their quick ratio, which strips out inventory and only counts the most liquid stuff like cash, it's still incredibly strong at 360. They have more than enough cash on hand to easily cover any short-term bills. So operationally speaking, from a risk of ruin perspective, FormFactor is remarkably safe.
But here's where things get weird. Section 3, the missing growth engine. The plot thickens. A safe balance sheet is great, but it doesn't automatically justify a quadruple-digit stock surge.
Okay, here is the absolute core mystery of this entire explainer. Look at this disconnect. On one side, we have the market's reaction. Investors have been riding a 435% total return over the trailing 12 months. The market is practically screaming hypergrowth. But on the other side, look at the reality of the business. Top-line revenue over that exact same 12-month period barely crept up by 2.81%. Think about how crazy that is. The actual size of the business grew by less than 3%, but the price tag to buy into that business grew by over 400%. It's literally like your house appreciating in value by 4 times, even though you didn't add any new rooms and the neighborhood hasn't changed at all. And honestly, when we look at the actual cash being made, the contrast is even starker. You might be thinking, well, maybe revenue is flat, but they just got super efficient and hyper-profitable. Unfortunately, nope. The data shows the exact opposite. Net income over the trailing 12 months is actually down by over 22%. And worse still, free cash flow, the actual hard cash the business puts in the bank after paying its operating expenses, has completely plummeted by over 85% in that same time frame. They are generating a fraction of the cash they used to, yet the stock is priced like they have a money printer in the basement.
Because of this collapsing cash flow in the skyrocketing stock price, the yields have just been crushed. An investor buying in today is getting a free cash flow yield of barely 0.1% on their money, 0.11% to be exact. To really put that into perspective, you can easily get around 4 or 5% right now just sitting in a virtually risk-free savings account. By buying FormFactor at these levels, you're accepting a tiny fraction of a percent in real cash yield, taking on all the risk of the stock market, while the business's actual cash output is actively shrinking.
Which leads us to Section 4, the valuation disconnect, paying for perfection. When you combine stagnant revenue, a shrinking bottom line, and a soaring share price, the market is clearly paying for perfection.
I mean, check out this massive spike. The current price-to-earnings ratio is a staggering 208. To really understand how extreme that is, just look at the company's own historical baseline. FormFactor's 3-year average PE ratio is about 30. That means right now, today, the stock is trading nearly 600% higher than its historical average valuation. Investors are suddenly perfectly fine paying over $200 for every single dollar of profit FormFactor makes. And guys, it doesn't stop at earnings. The multiples across the board are just astronomical. You're paying 14 times the total sales of the company. You're paying nearly 11 times the book value of their actual assets. But the most glaring number here is absolutely that last one. Investors are currently paying an astonishing 983 times the free cash flow just to own a piece of this company. Theoretically, if the business kept generating cash at its current rate, it would take you almost 1,000 years to earn back your investment in free cash flow alone.
Across the board, whether you look at enterprise value to sales or enterprise value to EBIT, the cost of entry right now is historically unprecedented for this stock. The EV to EBIT ratio, which measures the cost of the whole enterprise relative to its core operating profit, is sitting at nearly 181. That is a massive 72% jump from its already elevated 3-year average. Literally every single lens we use to view valuation is telling us the exact same story. This stock is priced at an extreme premium.
All right, let's pull all our clues together. Section 5, Price versus Reality, the final verdict. Let's compare that massive price tag to the fundamental reality. To really do this right, we need to talk about the fair value price. Basically, this is a fundamental metric that mathematically strips away all the market hype, the day trading momentum, the emotional buying. It uses a discounted cash flow model to show what the underlying cash generation of the business is actually worth in present-day dollars. It answers the simple, crucial question, based purely on the money this business actually makes, what should one single share cost? And here is the most shocking clue of the entire explainer. While the stock currently trades way up in the stratosphere around $144 a share, the calculated fair value price, based entirely on the actual free cash flow this company generates, is a mere $10.77. I really want you to absorb that. The market is happily paying $144 for something that, based on current cash fundamentals, is mathematically worth about $11.
Because the price is so drastically detached from the fundamental value, it creates a staggering negative margin of safety of over 1,200%. In value investing, a margin of safety is supposed to protect you if things go wrong. A negative margin of 1,200%, that means you have literally zero protection. It mathematically demonstrates an absolute disconnect from fundamental reality. If the market suddenly wakes up and decides to value FormFactor based on its actual financial output instead of future hype, the downside risk here is absolutely massive.
So let's summarize what we've uncovered today, because it's a truly fascinating dichotomy. On one hand, FormFactor is a remarkably safe company. They've got a bulletproof balance sheet with virtually zero debt. They are not going bankrupt anytime soon. But on the other hand, the market has rewarded them with a 450+% stock surge, despite the fact that the revenue growth is practically stagnant at under 3%, and their actual free cash flow has collapsed by 85%. And all of this has resulted in massive overvaluation across every single historical metric.
So, I'm going to leave you with this final thought to ponder as we wrap up this explainer. The numbers don't lie, but the market is a forward-looking machine. Is FormFactor's current price tag anticipating some perfect, revolutionary future, maybe driven by an upcoming AI or semiconductor supercycle that the current financial statements just can't see yet? Or have investors simply abandoned math entirely, creating a massive, localized bubble just waiting to pop the moment reality sets in? Keep these numbers in mind as you watch how this stock performs in the coming months. Thanks so much for joining me on this deep dive, and keep learning.